Ever used an oxygen tank? The most important part of the oxygen tank is its valve. If the valve is shut, there's no oxygen flow. A hotel occupancy rate is much like the valve in an oxygen tank. The oxygen tank represents the revenue that a hotel must earn. Welcome to the 25 Financial Terms Beginner Hotel Managers Must Know series. My name is Lakshmi Narasimhan Soundararajan, and I will be your mentor in this entire series. This entire series is going to be simple, non-technical. We don't use any jargon, and it is something that you can use in your hotel operation. This video is going to be about the hotel occupancy rate. You saw earlier how revenue is like oxygen to the hotel business. If the valve of an oxygen tank is shut, there's no revenue flow. Similarly, if the hotel occupancy rate drops or disappears, there is no revenue for the hotel. It's that important a KPI. KPIs are key performance indicators, and hotel occupancy rate is one of the most important key performance indicator. Let us quickly see what's coming later in this video. Let's now jump into a few more details in this statistics section. Let's take a look at your companion during this 25 Financial Terms video series, the Paradise Hotel. This is the income statement of the Paradise Hotel for the year ended 31st December 2019. Never mind the multiple columns shown in this income statement. Pay attention to the particulars column on the left. We will be focusing on revenue, particularly room revenue, and more specifically in this video, we will be talking about the hotel occupancy rate. This is the statistics section of the Paradise Hotel profit and loss statement. The statistics section is normally at the bottom of the profit and loss statement and provides important information on occupancy, average rate, and other related information. Our focus in this video shall be on the hotel occupancy rate. However, before we get into that, let's look at some very important elements that do not form part of a hotel profit and loss statement. Pay attention to this set of 3 columns right at the top. Note that they read lean, standard, and peak. The hotel industry is a seasonal industry. So you have lean months, standard months, and peak months. So what do they mean? Well, a lean month, as you can see, is having a total occupancy of 66%. This is for the month of February here. A standard month, on the other hand, which is March, is showing an occupancy of 81% for Paradise Hotel. So you can see the difference between the lean month and the standard month. The peak month, which is the month of April, has the highest occupancy for Paradise Hotel at 93%. So you can understand how the operation of a hotel is seasonal in the sense that occupancies vary from month to month, and a lot of times they vary significantly. As you can see, the standard month is about 15% more than the lean month, while the peak month is 12% more than the standard month. This is the seasonality challenge that hotel managers face. They must ensure that the hotel occupancy rate is kept as high as possible. Let's now jump into a few more details in this statistics section. Note that the daily available rooms for Paradise Hotel is 150 rooms. This simply means the capacity of the hotel is 150 rooms. At the most, they can sell 150 rooms every day. Let's move one row down. What is this total rooms available, and how did we get 4,200? Well, in this particular instance, this is the month of February. So February has 28 days. If you multiply it by the 150 rooms every day, you arrive at 4,200 rooms. Note one row below that is the total paid occupied rooms. A hotel occupancy has two major elements: paid occupancy and total occupancy. We'll talk about paid occupancy. So in this case, the paid occupied rooms are simply the number of rooms that have a revenue generation in the month of February compared to the total rooms available, 4,200, which we just saw earlier. So what is the difference between paid occupied rooms and total occupied rooms? Note two items which are very common in the hotel industry. Complimentary rooms. Complimentary rooms are rooms that do not generate revenue. For example, if you are a blogger and you are writing a blog post on the hotel may give you a room free of cost because you are writing a post on the hotel, and so that is considered a complimentary room. The second type of non-paid room is a house use room. House use room means simply the hotel is using a particular guest room for its own purposes. For example, it may be doing some maintenance, which is normally the reason why a house use room is shown. So the difference between the paid occupancy and the total occupancy is actually these two: complimentary rooms and house use rooms. That is why you see there is a difference between the paid occupancy percentage, 60%, and the total occupancy percentage, which is 66%. Now, for reference, the 66% occupancy is the total occupancy including non-paid rooms. So if you see, the total room revenue shown here is actually generated by the total paid occupied rooms. A hotel occupancy rate we saw earlier is like the oxygen tank, right? And if you shut the valve, as in if you don't have occupancy, then your hotel revenue is going to be zero or close to zero. For reference, during the COVID-19 pandemic, this is what happened to hotels. Hotel occupancies dropped drastically, some to 10%, 12%, even for giants like Marriott and Hyatt and Hilton, etc. So it's very important to have the hotel occupancy rate healthy, because that is one of the factors that generates revenue. The other factor is the average daily rate, which we shall see in the next video in this series. So you can see that the hotel occupancy rate is such an important element of the revenue generation process of a hotel. Let's close with understanding how certain calculations have been arrived at. For example, how did paid occupancy become 60%? Well, it is actually the paid occupied rooms, 2,772, divided by the 4,200 total available rooms equals the 60%. So you can see that the paid occupancy percentage is directly the formula which reads as total paid occupied rooms divided by total available rooms multiplied by 100 in order to get a percentage. Now the total occupied rooms are simply for reference purposes, so that the hotel knows, apart from the revenue generating rooms, what is the percentage of rooms that do not earn a revenue. Many times a hotel may be undergoing a renovation, during which it may be taking out a lot of guest rooms in order to renovate. This would mean that its house use rooms are going to be very high. Ideally, the hotel would not want to use this renovation process during a peak month. So it generally tends to happen during a lean month. If you liked this video, consider subscribing to the Profits Masterclass channel. For future videos in this series and others, straight to your inbox.